Hey everyone, welcome back to Wealth for You, the place where we break down investing in simple, no-nonsense terms. Today we're diving into a Singapore household name that most of us know and trust, Sheng Siong. You've probably grabbed groceries from there, picked up their house brand snacks, or even watched their variety show. But have you ever wondered, is Sheng Siong stock still a smart buy in 2025? With costs rising, competition heating up, and store expansion plans underway, there's a lot going on behind the shelves. Stay with me till the end, because we're unpacking Sheng Siong's latest financials, hidden strengths, real risks, and whether it's still worth your money today. If you enjoy local investing insights like this, smash that like button, subscribe to Wealth for You, and turn on the bell so you don't miss a beat. Disclaimer. This video is for informational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before investing. Chapter 1. Company Background. Sheng Siong started way back in 1985, not as a full supermarket, but as a small pork counter in a single store. It was started by the Lim brothers. Truly a humble beginning. Today, Sheng Siong is one of the top 3 supermarket chains in Singapore. As of early 2025, they have 77 stores across Singapore, mostly in HDB heartland areas. They've also got 6 stores in China, mainly in Kunming. Their business model is simple: value-for-money groceries, targeting the everyday Singaporean. Fresh food, house brands, and essential items all under one roof. And they're still expanding, planning to open up to 10 more stores in Singapore this year. In China, they're moving more slowly, as growth has been harder and more costly there. Chapter 2. Latest Financials. Let's look at Sheng Siong's latest financial performance for the first quarter of FY 2025, ending on 31st March 2025. Revenue increased by 7.1% year-on-year to 403 million Singapore dollars, driven by contributions from 8 new store openings and higher festive sales during Hari Raya in March. Gross profit grew by 10.2% to 122 million Singapore dollars, with gross profit margin improving by 0.9 percent points to 30.3%, supported by enhancements in the sales mix. Net profit rose by 6.1% to 38.5 million Singapore dollars. Earnings per share, EPS, increased by 6.2% to 2.57 cents. Other income increased by 18.1% to 4.7 million Singapore dollars, mainly due to higher rental income from expanded leased space and government grants under the Progressive Wage Credit Scheme. Operating costs, selling and distribution expenses rose by 13.3% to 65.8 million Singapore dollars, and administrative expenses increased by 8.8% to 15.8 million Singapore dollars, primarily due to higher staff costs from variable bonuses and more employees hired to support new stores. Cash position. Cash and cash equivalents stood at 366.9 million Singapore dollars as of 31st March 2025, a 3.8% increase year-on-year. Chapter 3. Stock Valuation. Let's talk about the stock. Market cap, around 2.6 billion Singapore dollars. Share price as of May 2025, approximately $1.75, near its 52-week high. Price to earnings PE ratio, about 17 times earnings, close to its historical average. Price to book PB ratio, around 4.5 times. Dividend yield, between 3.6% to 3.9%, with a 70% payout ratio. So yes, Sheng Siong stock is not cheap. It's priced at a premium compared to its competitors. But here's why. Chapter 4. Strengths. Let's look at what makes Sheng Siong strong. 1. Strong brand and customer loyalty, especially in HDB estates. 2. Resilient business model. People still need groceries even in bad times. 3. Efficient operations. They own their own distribution and processing facilities. 4. Over 1,600 house brand products, higher margins, better value for customers. 5. Low debt and strong cash reserves. Over 366 million Singapore dollars in cash. 6. Consistent profits and dividends. Great for long-term income investors. And with giant closing stores, Sheng Siong is grabbing market share, now estimated to be above 20%. Chapter 5. Weaknesses and risks. But of course, no company is perfect. 1. Rising operating costs. Staff wages, utilities, and rental costs are all up. 2. Heavy reliance on new stores for growth. Same-store sales are slowing down. 3. China expansion is risky, contributes less than 3% of revenue, and is still making losses. 4. Strong competition. Fair Price is still the market leader and expanding digitally. 5. Valuation is rich, trading at a premium, so any slip-up could hurt the stock price. So while Sheng Siong is solid, it's not a cheap buy anymore. Chapter 7. Is Sheng Siong still a good buy? Here's the big question. Is Sheng Siong still worth buying at today's price? If you're looking for a safe, defensive stock with steady cash flow and a solid track record, Sheng Siong remains a dependable choice. It's well-run, financially strong, and continues to do well even during uncertain times, because let's face it, groceries are always in demand. But if you're hoping for high growth or significant capital gains, this might not be the stock for you right now. At a P/E ratio of around 17 times, the market has already priced in much of Sheng Siong's solid performance. That means unless the company delivers surprise growth, for example, making serious progress in China, the upside may be limited from here. Also, while Sheng Siong pays out about 70% of its earnings as dividends, the yield at current prices sits around 3.6 to 3.9%, which may not be very attractive to income investors looking for higher returns, especially when compared to other dividend-paying stocks. So ultimately, it comes down to your goals. If you want stability and reliability, Sheng Siong still makes sense. But if you're looking for undervalued opportunities or faster growth, you may want to explore other options. Closing thoughts. So what do you think about Sheng Siong stock? Is it one of your core holdings, or are you waiting for a better entry point? Let me know your thoughts in the comments below. I read every one of them. If you found this breakdown helpful, do me a favor, smash that like button, subscribe to Wealth for You, and hit the notification bell so you never miss future insights on local stocks and smart investing tips. Thanks for spending time with me today, and I'll see you in the next video.